gold getting as high as $6,600 here in the near term. And so we are beginning to see a lot of people talk about this. You have Jeffrey Gunlock, I believe is his name, and he's, if I'm not mistaken, a trader for BlackRock, talking about, again, people need to add gold to their portfolio, breaking free from this 60-40 split over the next several months and into Q1 of next year, that his momentum indicators are seeing silver as high as $100 to $200. And he says that they expect such, because in my mind, as much trouble as China is having, their yuan gets saved by gold, and the dollar without gold to back it, it goes down. And maybe that's why we're seeing all of this gold come back to have it tied to a new system.
Gold and silver are increasingly being recognized as core assets in a world where traditional portfolio models are breaking down. The old 60-40 split between stocks and bonds is losing credibility as inflation, debt expansion, and monetary debasement continue to erode the value of fiat currencies. Major institutions, from Morgan Stanley to Bank of America, are now recommending allocations of 20 to 25% or more into precious metals as part of restructured investment strategies. Analysts project gold reaching levels as high as $6,600, while silver could surge into the $100 to $200 range as momentum builds. This shift isn't just about speculation, it's about preserving wealth in an era where currencies are faltering and central banks are quietly preparing for a gold-backed system. AndySchectman, a respected voice in the precious metals industry, has long warned of these structural changes. His perspective ties together institutional portfolio shifts, technical momentum signals, and global geopolitical moves, such as China's strategy of building gold vaults across the global south, as signs of an approaching reset in monetary trust. The signals from Wall Street and central banks are clear. Precious metals are moving from the margins to the mainstream. Now, we present the clips from AndySchectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates, and enjoy the video.
You know, we talked about the chief investment officer of Morgan Stanley shifting his allocation model to 60-20-20, where it was 60% stocks, 20% bonds, 20% gold, breaking free from the 60-40 model that has been been out there forever. But now it's going deeper than that. And now you see Bank of America, Michael Hartnett, who is talking about a 25-25-25-25 portfolio, where the strategy is 25% stocks, 25% bonds, 25% treasury bills. Those are the short term, and 25% gold. And he talks about how that strategy is up 16% year to date, whereas the plain vanilla 60-40 is up only 10%, yet gold is up almost 50. Just goes to show. You got a guy named Chris Wood, I think is his name, Chris Wood, the global head of equity strategy at Jefferies. Jefferies Beige was the name of it before, or Jefferies Beige. It used to be Prudential Beige, and Jefferies bought the Prudentials, who nominated Miles Franklin to be an authorized reseller of U.S. Mint product many years ago. So, Jefferies took over for Beige and then got out of the gold business. Evidently, they didn't believe it was the path for them to take, yet now their head of equity strategy is talking about gold getting as high as $6,600 here in the near term. And so we are beginning to see a lot of people talk about this. You have Jeffrey Gunlock, I believe is his name, and he's, if I'm not mistaken, a trader for BlackRock, talking about, again, people need to add gold to their portfolio, breaking free from this 60-40 split. And I guess when you see players at this level start to talk about it, certainly we should take notice. I also found it interesting, Michael Oliver talking about metal. Michael is a frequent visitor to your show, and he was talking about the lid coming all the way off is what the MSA is what they're predicting, his moving averages or his momentum averages, momentum indicator. And he says that over the next several months and into Q1 of next year, that his momentum indicators are seeing silver as high as $100 to $200. And he says that they expect such. He also talks about not being fooled by any sharp drop that we see. he looks back to the way the markets reacted before previous bull markets, and he says they fully expect to see a corrective jolt at some point, but it's part of the current upward progress, and so not to be fooled by it. I found that. And he talked also about gold, which has broken through a 12-year-old gradual uptrend channel. Again, technical analysis, but basically saying that he thinks that this month is poised to produce a new high peak monthly close on annual momentum. There's only a few days left in the month. Again, these are all very, very, very bullish things for the price of gold. And I just think that people in this country have yet to recognize that gold is rising and rising against all the G7 currencies. But it's not about gold. It's about loss of purchasing power in all of these currencies. And all of these currencies are now basket cases. So yeah, I think that, wait until China really starts to turn up the heat and starts to dump treasuries at a faster clip. I think maybe that's why we're seeing all the gold come back and the talk of tying gold to a new monetary system, because in my mind, as much trouble as China is having, their yuan gets saved by gold, and the dollar without gold to back it goes down. And maybe that's why we're seeing all of this gold come back, to have it tied to a new system. I'm not really sure, but when we see China building vaults all throughout the global south, starting with Hong Kong and then Saudi Arabia. You'll have the vaults in St. Petersburg, of course in Shanghai, in Singapore, Dubai. These will all be connected and tied to this gold vaulting system, where nations' golds are held in vaults in their own countries. And I think that'll be ultimately trusted much more than what we see in New York and in London. Jeffrey Gundlach, he is they call him, that just came to me, call him the Bond King. And he is saying that it's time to move away from traditional 60-40 split. This is a guy who, in essence, it's like the casino betting against their own game, speaking out against their own game. He's saying that you'll see gold at 4,000 by year end. And he talks about that your savings account is bleeding out, at least at 4% per year, but actually it's probably a lot more than that. They talk about a money supply that has increased by as much as 7% per year. You see M2 again racing higher right now. So as we see money creation running at such a level, your $10,000 right now after an 11% drop is worth $8,900. And so if you're buying treasury bonds paying 4%, that's $400 a year on your $10,000. The IRS is going to take $100 of that right off the top of your $400 profit. But when you look at the debasement of the currency, you're negative between taxes, where if you're buying bonds and it's like the government is taxing you for lending them money, which is really stupid. But between the monetary dilution of money supply growing at between 7 and 10% annually, the dollar down 11% now, the taxes on top of all of this, it's a losing game. It's no wonder that they don't say this. So, your $10,000 just lost $700 or $800 or $900 in real purchasing power, if not a lot more, actually more like $1,200 or $1,300 in less than a year. And that's the kind of thing that I think is really, this is what owning precious metals is all about. So the big money, the central banks and the commercial banks, well, they've already got their seat at the party. Now they're saying to their big money who they want to take with them on the ride, reallocate. But the people down here, they don't hear any of that yet. When they're told to reallocate, you might want to start to think about what happens next, because the big money will have been in position long ago. And that's when all the profits are made. And, again, we don't buy this stuff to get wealthy. We buy it because it is wealth. And the biggest money in the world is signaling that right here in front of us.
Gold and silver are showing extraordinary strength, with gold up over 40% this year and silver rising more than 50%, marking their best performance in nearly 50 years. What makes this surge even more notable is the backdrop. Record short positions in SLV and GLD aimed at suppressing metals prices, yet demand remains powerful enough to push both markets higher. This imbalance reflects something more profound than speculation. It signals structural changes in global finance. Across commodities and trade flows, the shift away from the US dollar is accelerating. China's decision to source record levels of soybeans from Brazil while settling transactions in yuan instead of dollars represents a direct challenge to the dollar-based system. The BRICS Pay network, yuan clearing arrangements, and gold-backed alternatives reinforce this chipping away process. Instead of recycling trade surpluses into U.S. treasuries, nations are now holding gold and building vaults across multiple jurisdictions. When combined with the declining purchasing power of the dollar and the relentless global demand for metals, it becomes clear that the financial order is tilting toward a multipolar, gold-anchored structure. Precious metals are no longer a hedge on the fringes. They are becoming the foundation of a new system. Let's get back to the interview.
You would think by now people would wake up to this, especially since gold prices are up 43% this year to date. This is putting them on track for the best annual performance in 46 years. You would think that people would start to wake up to this. Unfortunately, they're always late to the party, i.e. the little man rule. It's the big money who is there right now, and it's the big money that is moving in this direction. I want to talk a little bit about, I try and touch upon the BRICS a little bit each time. Sometimes it's hard because sometimes the information's hard to find or it just isn't really earth-shattering. This is one of these deals that really isn't earth-shattering, but I think people should pay attention to what they're doing. So I think that the U.S. is foolish in the way that they have stood up against the BRICS countries with tariffs. And soybeans, China used to be the biggest purchaser of soybeans from U.S. farmers. And you look at the Chinese import numbers for soybeans, in August, they were at historically high levels, like the most ever. But the majority of these purchases are now coming from Brazil and other South American growers. And over 12 million tons of soybeans came into China in August. It's the second highest monthly total ever. And almost all of it, 11 million tons or more, about 85 to 90% of all of the soybeans came from Brazil. And now China has logged 4 consecutive months of record soybean imports. And this is, again, I think it's because of supply uncertainty with the United States, because of the trade war. Okay, well, so what, people would say. Well, this is, to me, a very big so what, not only for the American farmer, but also for the American government. Most of these global soybean trades were invoiced in U.S. dollars. And now they're not. And so payments would have to clear through U.S. dollars through the international intermediary banks via the New York clearinghouses. This gave the dollar its dominance. This is what I've been talking about, in our conversation today with Rick and Alistair earlier, talking about chipping away at dollar dominance through settling trade, whether it be the BRICS settling trade on government-to-government level like this, which I'm going to touch on in 1 second, or the BRICS Pay network, which will allow business-to-business, retail, business to the retail market also to transact outside the dollar. Every one of these transactions is like an axe against like one of the giant redwood trees, chipping away at this new system, which isn't using dollars to settling over whether it be BRICS Pay network, whether it be over the BRICS Bridge network, or they have something called a direct yuan clearing arrangement that they made in Brazil. Chinese did, and it allows the exporters, including the big soybean exporters, to invoice China directly in renminbi across the renminbi cross-border payment system, which settles in 7 seconds outside of SWIFT. And so this cuts out the U.S. dollar out of the loop completely. So the Chinese importers pay in yuan, and the Brazilian sellers can either hold the yuan or convert them into gold or real if they want, but converting them into gold. And soon in all of these countries, whether it be the BRICS countries or the Belt Road, they'll have Shanghai vaults where metal is stored in all of these jurisdictions, all these multi-jurisdictions. And so you have the system that is being built little by little to cut out the dollar completely, not only in settlement, but also in reserve status. Instead of putting excess into treasuries, they will simply put them into gold because gold is backing this whole system. These are the things that a lot of the people who do not talk about who push back against the BRICS and say that they are not as legitimate as perhaps we would think they are. And to me, that is a very silly mistake to make. And you can look at just the info coming out of the Bureau of Labor Statistics and, the BLS, take the L out and they're just the BS. That's all they really are. But even using their own BS, the dollar is worth 82 cents of what it was worth in 2020. That's a 22% decline in the value of our money in 5 years, and it's probably worth a whole lot less. And, so I think when you talk about why these countries are doing it, not only is it the loss of value in the dollar, not only is it the weaponizing of the treasury market, but it is also the silliness of the imposing of these sanctions or these tariffs that are making all of these countries say, screw it. And then you look at, gold futures are past $3,800. And again, you're talking gold and silver moving up, gold's up almost 9% in September alone. And silver's up 9 or 10% this month alone, up over 50% year to date. So you can see why all of these countries are accumulating gold and silver. You can see why the United States is. We've talked a lot about silver and how the open interest in silver had declined from 184,000 contracts in June to 154,000 in September. This means that there was covering in contracts. That means that the open interest was declining. Yet the price continued to rise above $40 in the face of a declining open interest. Declining open interest, meaning less people involved or speculating, and rising price, in theory, only happens in a bear squeeze, where the shorts are covering because they're afraid. And now I would argue it's rising because the long speculators realize that metals are in a bull market. And you got to wonder what the shorts are thinking right now as it continues to move higher. But you see all of the silver coming in, almost 11,000 tons of silver have come in this year. About 60% of global mine supply for 9 months have come into the United States. And so basically what you're seeing is, I think, a reawakening again of what silver has to offer. Now, if being on the short side of this has to be terrifying, as we're seeing now massive investment interest in there. Maybe this is why we're seeing such a huge short position in SLV. They're running out of ways to hold the price down. And in the face of rising short positions, silver and gold are still doing well. Of course, they're doing it in SLV and GLD, a little bit more opaque, instead of putting it right on the COMEX. But even still, you're beginning to see big money start to challenge the suppression of gold and silver. And I don't know, I think that it's not just gold and silver, it's platinum, which is up almost 65% this year. And so, yeah, you're seeing, again, what's China doing with platinum? They're importing platinum at a run rate of 58% of global mine supply. Again, it's not just gold and silver, it's everything. Precious metals, base metals, commodities like soybeans. They're doing everything they can, and they're paying for it and doing it in ways that are pushing back against the dollar. But to my point about the short positions, the short position in SLV exploded 67% higher, and gold almost 70% higher. This is aimed at keeping metals down. Now, normally such a barrage of these shorts would crush the price. It's textbook suppression. Flood the market with borrowed shares, push the chart flat, kill the momentum, kill the rising price. But the effort, this enormous effort to hold it down, is pale in comparison to the demand, which is even stronger. And I think that's very, very scary to these shorts. If gold and silver are holding this strong under record short pressure on SLD and GLD, what happens when that pressure fails? And I think it is failing right now. So yeah, I would expect to see much higher prices in gold and silver moving forward. I really do. And I don't know. I think it's just the beginning, Dunnigan.
The acceleration of de-dollarization is no longer theoretical. It is unfolding in real time across trade, finance, and commodities. From BRICS nations bypassing SWIFT with new settlement systems, to record imports of soybeans, gold, silver, and platinum conducted outside of dollar channels, these moves may appear incremental in isolation, but collectively, they represent a steady erosion of U.S. monetary dominance. Each transaction settled in yuan, each vault filled with bullion instead of treasuries, adds to the irreversible momentum. At the same time, precious metals are quietly redefining their role in global portfolios. Gold's surge to multi-decade highs and silver's powerful rally demonstrate the strength of the underlying demand. Even under coordinated pressure, these markets are proving resilient, a sign that something much larger is at play. What we are witnessing is not simply a price rally, it is the re-emergence of gold and silver as the bedrock of credibility in a system where trust in fiat continues to erode. The implications are massive for investors and nations alike. Positioning ahead of this shift is no longer optional, it is essential. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.